And so we've seen a shift, I think, across all asset classes, but especially in the VC ecosystem, of focusing on companies that already have traction and demonstrated product market fit. And even if they're not profitable yet, they have a clear plan and path to get there that's reasonable and something that you can look at, and a reasonable person would say, okay, I think this can be achieved.
We've seen situations where people are not actually following through and looking at what's actually happening in the company. And that's not the case of the founder. In most cases, the founders are, here's my stuff. It's the case of the investor that's not looking under the hood, not, you don't go buy a car and never turn it on. You don't go buy a car and drive it off the lot or test drive it. Like if you just show up and bought the car and you bought a lemon, that's on you. Like as an investor, the goal is to not, and we talk to a lot of LPs. It's like, it's not about, I need to do this, I want to do this. It's like, take a step back, figure out whether or not you know the space or not know the space. What do you need to make the decision? And if it requires you that you align yourself with a fund manager that has an experience in the space, that that also has a plan on how to make money, that's also plan on like what happens if things go bad, how are they going to fix that? Because anyone can sit there and do random bets. It's doing the educated bets that's going to make you money. I think, going back to the power law method, it's great when everything's a unicorn. When you're at a time that no one's raising money and no one is profitable, and then now seeing those 98% of failures, that's when the failures pile up. But it's how do you take that educated bet to make sure that you actually know exactly what you're going to get yourself into.
So let me ask you a question that I think will kind of summarize some of the stuff we've been talking about. And the question is, what are the key investment principles that you live by? And I will say that we've already talked about revenue, which is great. So principle number one would be, do they have money, right? Have they made money? Do they have traction? But what are the other principles that you live by and that you look for in teams that you're going to invest in?
Yeah, I think the second big one is the team coachable. At the end of the day, can they take advice from not just you as an investor, but a board? Can they go in and scale it? Because at the end of the day, this business is about people, regardless. People are trusting Zach, people are trusting Adrian, people are trusting, founder A and founder B, and they have to be able to be not just trusting enough, but be able to sell, to make revenue, but also sell themselves to an investor, to a customer, to potential hires. Because at the end of the day, if nobody wants to work for you or work with you, you may have the best company, the best product in the world, but at the end of the day, if there's nothing there, that's what's going to kill you. And if you can actually, get people to, to work with you, it's what I call the reference of, can you get people to believe in Christmas? To give up, reason and say, I want to do this. I want to be part of this company. Because if they can't help hire, that's now going out, finding recruiters to do it. If you can't retain people, then you're like losing money and you're losing, IP, and you're using, brain, the brain power there because people are leaving. And that is really, really important because the coachability of those individuals. And it's not just, everyone thinks that it's the founder and CEO. It's not just that, it's the executive leadership team. Because as you're scaling, you're trying to, tease out in an early stage, is this the cult of the founder? And, is it just this one person that makes every decision, or are they able to build a team around them? Because once you're at 200 employees, it can't be one person. It has to be an executive leadership team, and you need to see, and this is why we do that 2 to 3 months due diligence. We want to see what happens with the team when there's a success, what happens when there's a failure. Because at the end of the day, that reaction from the founding team, from the executive leadership team, is going to tell you whether or not they can get coached, whether or not they can grow with the company, but at the same time, also as an early stage investor, painting the picture of at a certain point that team will have to get replaced. If you are a 2-person team and you go to 200 people, no one says that you can run 200 people if you've never done it before. And that's the important power. At the same time, I think the reality is we used to say it was product, but product, which is the next piece, I think it balances out with revenue. We've seen a lot of dumpy products that can sell versus we've seen a lot of great products that can't sell. And I think it comes down to, they each need each other. The coachability, the team, the ability to generate revenue. That's why for me, the revenue piece is so important. Do customers early trust you and the team? That generates revenue. Do they believe in the product and use the product? That generates revenue. Are you able to raise funds from other investors because of revenue? And that's where I think as I've grown up in this business, that's why it's so important as an indicator of what, how can you actually measure success?
There's one short-term factor that I've been thinking about that's not an investment principle per se. It's more of a tactical opportunity. And I think that companies that have more liquidity and stronger balance sheets and therefore longer runways are going to have a huge advantage over those that don't over this next phase of the cycle. Because my base case is that things are going to get pretty ugly in terms of macroeconomics. We'll probably have a severe recession. Asset valuations will fall. And what that means is that there's going to be a lot of stress on these startups. Like if they think they're stressed now, wait until the stock market's down 40 or 50%, wait until unemployment's up and rates are still high and inflation's still rampant, right? So my thinking is that companies that have the ability to withstand that negative economic period will be longer lasting and therefore rise to the top, not because they necessarily have even the best team or the best product, but simply because their competitors get eaten along the way. So it's this idea that Kelly Perdue, who runs Moonshots Capital, mentioned on a former or previous podcast. And he said, if we're out in the woods and we see a bear, I don't have to outrun the bear. I just have to outrun you. Right. And so my thinking is companies that have more liquidity, they don't even need to be the best product. They could be number 5 in their category. But if everybody's under the gun over the next couple of years and they survive because they've got more liquidity and more runway, they will therefore be, they will rise up. They will be number 3 or number 2 or number 1 in their product category because the others get eaten by the bear.
It's funny because I use the bear analogy for something else. And it's funny enough, Kelly's completely right. This is why we're seeing, a strong mergers and acquisition market in the next 3 to 5 years. It's why we're seeing it now, because there's going to be a consolidation. Whether it's buying a company because they have capital, buying it because they have people, or buying it because they have tech. And I've gone on other podcasts. I talked about what it takes to sell a company. We've sold, a couple of companies already in the past. We sold one this year. It has to be about that positioning and what you think. But the crazy thing, and this is going to my bear analogy, I was on a panel with a bunch of VCs and I asked the question, all right, there's all these dollars sitting on the sideline. What's the bear going to do? Is it going to be a sleepy bear next year? Is it going to be a hungry bear? And everyone was either 50%, hey, I think the bear's not going to move and no money's going to go. Or I think it's going to be a hungry bear. And I was like, no, it's going to be a bear on cocaine that is throwing money at every ridiculous thing. But that's just as worse as the bear eating people, because now you have terrible companies that have raised a bunch of money because investor money has to go to work. And that in itself will create a mess, because whoever happens to be in front of the bear, will get a check. And I think that is just as dangerous as the bear that eats you.
Yeah, I mean, that's what we're seeing now in AI. I think people are writing checks that they don't really understand, in my view.
Yeah, checks they can't cash. Yeah. And next thing you know, they'll be like, there was nothing here. I do the same thing when you talk about the AI team. I go in to start talking about like the data. Tell me about your training data. And they're like, what? Well, it's like, how you make the decision. How many data points do you have? And they're like, but I don't have data. And it's like, well, then how do you expect to make a decision? And I think it's really important. It goes back to doing the due diligence on how do you actually know this market? What are you actually investing in, and what are the outcomes?
So just to wrap up the thought on investing principles, coachable team, not just a coachable founder, but an executive team that's coachable and also versatile, right? And able to grow as the firm grows. So that's point one. Point two is, having a strong product, of course, is important, but probably more important is showing traction and the ability to sell that product.
Because you see a lot of, the nice thing of where we are in the space, because we're waiting for the companies to have 1 to 3 million in revenue, we're going to look at all the earlier stage companies in a sector and in a vertical, and then you start seeing like the winners emerge, those that have that 1.5 million in revenue. And the reality is, it's not always going to be the one that has the best technology. It's not always going to be the one that has the best team. It's the one that could survive not getting eaten by a bear. And really where it comes down to is who can sell it. Because once you're selling, 500,000, a million, it's hard to rip something out, especially on the enterprise side. And that's what people don't realize. It's not like once, a Microsoft, once an Amazon buys a product or service, they don't easily rip it out. This is a 3 to 5 year contract. And we saw this, and I'll use a perfect example of in the fintech space. 5 years ago, everyone was convinced that they were going to build a brand new finance core. It's what powers a bank. It's what powers a credit union. And there were incumbents in the space, and many a startup died on the hill. Whether they had an AI algorithm, whether they had blockchain, whether they had hamsters running on wheels or bananas, like literally everyone died on that hill. And it literally came down to, you go to the bank and you're like, do you want a better product? Yes, I do. Do you want it to do this? Oh my God, yes. Do you want it cheaper? Yeah, of course I do. Dude, I got a 5 to 10 year contract. It took me 3 years and $1 million to implement that core. I'm not gonna rip it out. Are you mad? 5 startups, 10 startups just died on that hill. And that's the key thing, that everyone thinks, oh, I'm just going to innovate. But it comes down to, once some of these bigger players choose who that company is, these markets are set.
You're right. A lot of people slipped on the banana peel, running on banana peels. That's Are there any other key investment principles that you think are worth touching on in addition to the ones that we talked about?
You know what? I've been early to market and I've been late to market. And a lot of it is, product marketing fit. Do you have something that people want to buy? Are you too early? Are you too late? And the reality is, I hate to say it, a lot of it is just dumb luck. Are you at the right place at the right time? Doesn't matter how smart you are, what best product is, you just happen to be at the right place at the right time. And I know I've built companies that were too early or they're too late, and I know when it's right to be at the right time. And that is just as important to, as you're looking at, investing in these companies, like, am I late? Are they doing something that just that people have already bought? Are they doing something that nobody wants to buy because nobody actually, is educated enough to buy it? Or there's just way too many people in the market and way too many competitors. And that's, at the end of the day, as an investor, when you take a step back, like, people will say, oh man, you should look at, marketing data, and you should look at, what's the total addressable market. It really comes down to is looking at the entire landscape and seeing where all the competitors are. If you're looking at a vertical and no one can sell, who says that you're going to find one that will, sell something if no one is selling? If you now have 10 or 20 competitors all doing the same thing, then it's noise to the customers. And that's the important piece of taking that step back. And when you're doing due diligence, is to be able to look at what these levers are. Is it that they need more cash? Is it that they need more people? Or is it that they need more customers? Like, what is it to be able to pull these levers? Because when you get to the point of where we're starting to invest and where ARI is investing, it should be fairly mechanical. You should pour money in and you should show quickly how you generate revenue or how you generate customers. And that's the important thing is you go from that very early stage evangelical sales cycle where you're just preaching to the converted to now it just comes down to metrics. And that's the important part of where we both are is the analysis of those metrics. Like if I give you $1 million, what comes out at the other end? If I give you $3 million, what comes out at the other end? If you're already making $3 million, are we assuming that you're going to continue to make $3 million? And that's the important piece of when you're looking at it, beginning to look at operating models and cap tables and being able to look at financial modeling to make sure that the business is clean, it's not weighed down by anything, but also that their numbers are realistic. Because again, it's luck and realism. Sometimes it takes both.
Yeah, I think timing is incredibly important, which is, in any type of investing. I used to be a bond trader and a portfolio manager and a banker, and you could make a great trade or great investment at the time, but then because of the macro picture changing or things that are outside of your control, maybe it winds up not being so good. And it's kind of funny because in ARI's case, I started building it out a few years ago from scratch, and I was too early for the market at that time. Like investors were like, what's venture debt? It was literally over their head. Like they just had no idea what it was. They couldn't comprehend the fact that you could make 20% lending to early stage companies, even though people have been doing it for 20 years. And, that kind of slowed up that, and COVID, definitely slowed up fundraising for us. And the reality is it was the best thing that could have ever happened, because then SVB collapsed for reasons unrelated to venture debt. And the market's wide open now. Anyone investing in 2020 and 21 in particular, and 22, those are terrible vintage years. And it doesn't matter how smart you are or what your strategy is. If you are investing at the peak of the market, you're probably going to have some adverse returns, right? And so for us, it's perfect because we're raising capital or building the firm and raising capital during the peak of the market. And now we're the only one out there in the entire world that's got a clean balance sheet and an institutional quality fund ready to deploy fresh capital. And everybody else is worried about their existing loans.
Completely right. When you're at the top of the market, doesn't matter how good you do due diligence. If you're investing at a high valuation, doesn't matter how much if you have a warrant, because if the next round is a down round, there goes all your warrants, there goes all your underwriting, because you just got cut off at the knees. And right now, I think this vintage is going to be incredible for both of our funds. And I don't say that lightly, but looking at the numbers of our own fund, I was like, man, I call this by skipping that flatness and going straight to these businesses that have revenue that are still early, but you're going to help them pop and you're going to help them just climb the J curve. There's going to be some incredible fast returns that happen where no one else was afraid. Too many people were like busy running around being like, the bear's going to eat me. You and I started fighting the bear and we're winning. Take that, bear.
It's the perfect time to fund from that. I think this next year coming up, 2024, I think will be the best vintage year in the history of venture debt, and one of the best vintage years in the history of venture equity, because valuations are lower. You're getting great access to the best companies because they can't get funded generally by most folks. And so you can be incredibly selective. There's very little competition for deals, very different from 2021, where there was 15 term sheets for every halfway decent deal, and maybe even 15 term sheets for crappy deals, quite frankly. Now we're seeing great deals that are getting no term sheets. Nobody wants to fund them right now because they just don't have the money or they're not willing to deploy the capital. And so what that means is that if you're in a position where you have dry powder right now and you can invest, you're getting great valuations, and you're getting in at a time that's a perfect inflection point, because you're going to basically help them bridge this gap over the next couple of years where we're probably going to have a recession. And then you're going to be perfectly positioned to ride that upward trajectory with them. And so I just think it's preparation meeting opportunity. I don't like to call it luck. When people say to me, hey, you're lucky, I'm like, bullshit. Like, I called this, I was prepared, other people weren't, and now we're going to seize the opportunity.
Yeah, absolutely. I see it the same thing. I think this is just the right time, the right place. It's being ready to go and being able to then bring in the right LPs at the right dollars to say, all right, let's come in and let's also help you co-invest. Let's get you in access to these deals. Let's do everything that we have built the infrastructure behind it. And that's really the power about both of us. It's not tooting our own horns, it's just being honest, is we built this infrastructure already. Once you have the rails, you can put whatever train you want and roll it down the hill. And that's, I think, the power of it is, those that are going to use this year and next year to build their funds and their own rails, they're going to miss out, because by the time they deploy will be end of 24, 25. If you're not coming into the market now and deploying, you're just going to miss out.
It's funny. There's a lot of larger asset managers that are trying to get into venture debt. And to your point, they can't build it fast enough. And I've had a number call me and ask if I would come work for them, if they could buy stock in ARI, if they could acquire us outright. I'm like, no, why would I do that? Right? We're about to go hit a home run, and you're behind. Now you got to catch up, and you're going to have to open your wallet immensely.
It'll literally take them till 2024 to deploy. We see a lot of this in the secondaries market.
Yep.
For secondaries LP shares, there's a bunch of big asset managers. They're not going to be ready to buy until mid to end of 24. At that point, they've missed it.
Yeah, we got one shot. People that are waiting to bet after the race is run, they're going to miss out. People that are like, hey, let me see how you do over the next 18 months. I'm like, you're going to see how I do, but you're not going to participate. So when you see these big returns, don't call me trying to get in, because you already missed it.
Exactly. The doors are closed. Once the train leaves the station, if you didn't buy a ticket, you're not going to ride.
So changing pace here, what are some risks that are keeping you up at night as an investor?
You know what? I think the biggest thing is time. It's, time kills all deals. I think the reality is, with the right timing, the right dollars, the right infrastructure, you can do anything. And I think a lot of what we're seeing is, a lot of the people that are just trying to wait it out and realizing that that's a risk in the market, because you can't wait it out for the next 1 to 2 years. If you're not deploying and you're not having alpha in the next 2 years, what's the value of money not doing anything is going to hurt a lot of people. And I think that's really the thing about it, is when you look at, both from the manager side, the manager that's not deploying because they're worried and scared that they're not going to get a deal, it's a game of catch up. The LP that's waiting to next year, 2025, because they're too scared to do something, time is going to kill them. I think you have to this is about calculated bets. This is, and time, the nice thing is time is on our side. The nice thing about it is we can go and do these 2 to 3 months due diligence versus, in the last 3 years, and I'll be very honest, the founders that ran up to us and said, we're going to close this deal right now, and your money needed to be in, those guys are gone. Those companies are gone. Those founders are gone. And it's funny, because it really is about time is the most important value that you can't get rid of. So the amount of time you do in valuation, that's important. The amount of time it takes you to do a deal, that's important. And I think that's the risk across the board of finding a good balance between you can't just always go, you'll burn out, but you can't also sit in the sidelines and not do anything. You've got to do a little of both. And that's why I think for, a lot of the funds that are doing well now, it's both deploying and raising all at the same time. It's being able to take a step back, but being able to do the risk to be able to show traction and also at the same time be able to show track record. Because if you wait till you deploy, a year and a half from now, there are no good deals. If you wait to fundraise, you're going to miss it. And so it's finding a good balance across both.
Yeah, I think you hit on something there, which is the risk for LPs is not doing something. So LPs tend to think of this risk of, if I do something, there's risk in doing that, but there's also the risk of not taking the action. In other words, there's the opportunity cost of missing out.
That's the key of it is, literally sitting on the sidelines and realizing that it's in bonds or treasuries, not generating any alpha, because this isn't the game of alpha right now. This is planting the seeds of returns happening in 3, 5, and 10 years. And the more you wait, those returns will get farther and farther on. And we saw this like very early on. Like I saw this with, the university endowments that didn't invest in venture 6 years ago. Those that did tremendously well. Those that didn't are now scrambling on, well, how do I do this? How do I get into venture? Versus the ones that, started 6, 10 years ago were able to generate fantastic returns because they saw things hitting the threshold and they saw things actually popping, and now they have returns, but it's about planting the seeds. And I think that's really, really important from both, the message to the LPs is, doesn't have to be big. It's, people ask about, all right, do you invest in this or do you invest in that? Are you going to do just all venture debt? And I'm like, no, you do everything. You diversify your investments across early stage, mid stage, late stage, and products like venture debt. Those are what the investors do. They found short-term, mid-term, and long-term products. And then that way, if one stalls out, you still have mid-term. If that stalls out, you still have long-term. And you're still looking at generating alpha. And that's really what the good CIOs should do. And that's the thing about, why both of our strategies do really well, because they have different time horizons. You have, milestones on 5 years and 10 years. I have milestones on 5, 7, and 10. And then being able to sync those up so that there are subsequent compounding returns over the next 5 to 10 years. And as a good LP into both funds like ours, that's what you have to look at is what is time horizon, but at the same time, like, what does it take to actually generate a good diversified return set over multiple different asset classes versus the LP that's just in one asset class, expecting that to be the end all and be all.
This is a conversation I have quite frequently with LPs, because a lot of folks I talk to are either family offices, large family offices, or registered investment advisors that are managing oftentimes billions of dollars, but sometimes on behalf of hundreds or thousands of clients. And a lot of them historically were only in stocks and bonds when it came to market exposure, right? 60-40 portfolio. And now many want to move into what's called alternative investments, which is anything except stocks and bonds. And usually the gateway drug, I call it, is real estate. That's the first thing that people invest in once they get out of stocks and bonds, because it's something everybody understands, right? Most people, almost everybody, well, everybody that would invest, of course, lives in a house, right? And they probably own it in most cases, and they often have been involved in commercial real estate. So they understand real estate. That makes sense to them. So they invest in that first. Then the next thing they usually do is they invest in private credit. And they think, okay, well, I understand real estate, both equity and debt on the real estate side. Well, private loans to corporates make sense as well, right? Like middle market loans, venture debt starts to make sense to them. And so what I'm seeing is more folks now are saying, what I want to do is get out of stocks and bonds, and I want to try to generate some higher risk-adjusted returns and alternatives. I've already done real estate. Now I want to take the next step. And this goes into your point, which really is about diversification. My point to these folks is, you shouldn't just pick one manager in venture equity and say, oh, this is the this is the one seed stage investor that we like, and this is the one private equity fund that we like, and the one venture lender that we like. Really what you want to do is diversify across multiple aspects. Previously, I've called this diversification within diversification within diversification. So first you move into alts. So that's diversifying your portfolio from just stocks and bonds. Then you move into real estate and private credit. And so you're diversifying within alts. And then within private credit, for instance, you can invest in all types of different loan strategies. And then within venture debt, don't just invest in ARI, invest in 2 or 3 managers.
Exactly it. And that's, you're right on the money. And that's what the good CIOs at family offices, at institutional investors, is they spread the risk between. And here's the thing, it's like, it's not just early stage, or it's not just venture debt, it's sector focused. All right, I want to have some exposure in biotech. I want to have some exposure in fintech. I want to have some exposure in this portion over here. I can have a venture debt fund that's ARI that's doing tech versus one that may be doing biotech or pharma. And that's really the power of taking a step back and having these different buckets, so that if one gets murdered, you still have another bucket. If that one gets murdered, you still have another bucket. The ability that the whole portfolio will go to garbage is pretty rare. We've done it really well and spread the risk out across sectors, across products, and across life cycles, late stage, early, mid stage, and I think that's really the power of what a good manager can help you with.
Are there any sectors right now that you think are going to do better over this next phase of the cycle? Like, what are you most interested in investing in sector wise?
You know what? I think cybersecurity is going to do really well. I think 5 years ago, 6 years ago, when we started, there was a lot of vaporware and garbage. I think there's a lot of incredible companies being created now by incredible founders that are seeing the need in the market, whether it be in fraud or risk or compliance. It's at the core of decentralized finance is embedding cybersecurity solutions and KYC. That, I think, is the next emerging stage. At the same time, I'm always looking at what is the next vertical, what's the next market. And I think, for us, the next piece is what I'm calling climate tech 2.0. You're getting away from building, solar and, batteries to software and financial transactions. That, I think, is going to be the course of that next innovation economy. A lot of money has gone in already. And you realize you're going to have data sets and finance and dollars moving through it that are going to require, fintechs and AI companies and cybersecurities to manage. And I think that is going to be the next frontier in the next 1 to 2 years that we're just going to start digging into, because we think there's an opportunity there.
Anything that investors should be thinking about over the next 3 to 5 years in terms of how to play innovation in their portfolio?
Yeah, I think we covered this one. I think it's diversification. I think it's looking at short-term and long-term investments. I think what people don't understand is when you're investing in an early stage company, that is a 10 to 16 year life cycle. So these are long-term investments. And being able to find a balance between that long-term, that may hit out that long, but also in, all right, how do you diversify into something that's shorter term? A product that you're doing that's going to generate, alpha quickly, and that 15% return, a middle stage product like us that is looking at 5 to 7 years. Because I think, a lot of people think, oh, this is just going to be, I hear this from LPs, oh, this is going to be liquidity in 6 months. And I'm like, yeah, that doesn't happen like that. These are long life cycles, unless you're, especially without, IPOs happening. And I think it's taking a step back at your own portfolio and looking at it and saying, what are the goals in the next 3 to 5 years? How do I diversify my risk, but also start laying down the groundwork for those 5 years, 7 years, 10 years? And what you do in the next 3 years is going to be critical. If you lay down the wrong investments, the wrong seeds, then nothing happens by year 5, year 7, and year 10. And it's critical now to be able to team up with the right manager, with the right co-investors that are going to be able to help you into these markets, into these companies where you get to learn about these investments, but also being able to build your own portfolio. And I think for me, that is the critical thing of the next years is, a lot of people are going to miss this window. So the key is, what do you do to make sure that you're have a foot into this space of alts where you're able to kind of generate alpha when people are not going to be generating alpha?
100% agree. Adrian, it's been great having you on today. I always enjoy talking to you.
The captain, thank you again.
Hey, before we go, let's take a look at that good-looking puppy. Hold him up to the screen.
Oh, this puppy over here?
Oh, wow.
One free plush dog with every LP investment. Look at him. He's very cute.
What's the best way for folks to reach out to you, whether they're a startup or they're an investor?
LinkedIn. I'm pretty active on LinkedIn. Feel free to reach out, send me a message, say, hey, I saw you with the captain. Would love to talk, and then happy to talk from a startup and happy to talk to a potential LP as well.
Awesome. Well, thanks again for joining, and thanks everybody for listening to the 7 and 7 show with Zach Ellison, and we'll see you next time. Take care.
See you next time.